Hi, this is John Butler, Vice President and Head of Wealth Services at GoldMoney. I'm here at the Money 2020 conference in Copenhagen. This is day 2. We're receiving a lot of interest around gold, which is great. But of course, a lot of people are skeptical. A lot of people aren't sure exactly how to value gold.
I think people forget. Let's just go back to 1967 right now, and you're not really allowed to trade in gold in the United States. And there are these authorized dealers. So Makata was one of them, and I remember speaking to some of the old-timers at Makata, and they're telling me, it's 1967 and the official gold price is $35 an ounce, and yet the price in London starts to hover $3, $4, $5 above that. And so Makata is sitting here in the United States buying gold at the official price of $35, buying scrap, buying from refiners, shipping it to London, selling it, and making this risk-free arbitrage that was basically incredible. And I think, on the macro side, basically, what was that? It was like de Gaulle was starting to demand his gold.
De Gaulle famously makes this speech where he says the dollar is the center of the international monetary system, but that's a national currency, and that an international monetary system should have an international currency. And he specifically says that gold should be the center of the system, not the dollar itself.
But basically, under Bretton Woods, the U.S., when there was a surplus of dollars ending up in France's arms or hands, and they wanted to redeem, they could redeem at a ratio of 35, the official price for gold. So I guess what was happening was de Gaulle started to demand some of that gold.
That's correct.
And so this was happening 67, 68, 69. And you were saying, I think, about the Vietnam War and
yes.
some of...
De Gaulle's words turned into actions in the late 60s because Vietnam is starting to become a quagmire. The U.S. is also spending all kinds of money on the Great Society, building the interstate highway system. These things are expensive. And de Gaulle and others get it. They understand the U.S. can no longer credibly back the dollar.
What's incredible is the
deficit.
The deficit as a percentage of GDP wasn't as high even then as it is today.
No.
That's what's so hilarious, that back then the discipline amongst trading partners was such that the second you got close to even running a deficit, whether it was trade or fiscal, and you were the reserve currency, we want our gold back. Okay, the social contract has been broken. And so I guess at this moment in time, Milton Friedman and all the economic advisors to Nixon, he gets elected to power. There's these pricing pressures, and I guess that they can't meet the gold demand, right? I mean, why else would they all of a sudden, and something happens, he's being kind of given some type of advice that allows him to go on TV and basically say, we are temporarily breaking the gold link.
It's over 40 years ago.
Yeah.
Typical politician, right?
Yeah.
Temporarily.
Yeah.
But look, I mean, obviously it was a crisis, and he had to try to restore confidence. And in fact, historians think his speech was a huge success.
Yeah.
Because there were multiple crises emerging in financial markets, in the currency, around the world. And here Nixon goes on television, and actually things really did calm down after that.
Yeah.
But he was buying time. He was buying time. He wasn't solving the underlying problems. So the U.S. was living beyond its means.
That's where I'm getting to. Is I'm kind of looking for the corollary in the present. But so 71, he makes this announcement, and at that moment, the London gold pool shoots up. Right, it goes to like $100, $150 right away. You couldn't buy it at 35, 40 anymore. Right, it was like right away it went to 100, 150. In the U.S., you still weren't allowed to buy the gold, right, until 73, I believe. In 73, it truly became freely floating. At that point, you could go and buy it. And so when you look at the gold charts in the 70s, it looks like it went from 35, the official price, and it kind of went up to 150 over 3 years. That's not true at all. It re-rated to 100, 150 right away. And then it oscillated there, and then the Iran-Contra affair begins.
And what were the oil prices? Now, growing up in the U.S., we were told this narrative that, those naughty oil producers are raising their prices because they can. Well, no, they were actually simply trying to get, in real terms, the same price for their oil that they got before the dollar was devalued versus gold in 1971-73.
So like a 4x value.
Absolutely. So they're simply restoring the previous price. It's not as if they were trying to be nasty about it. That's right. But this
is a function of energy.
That's right. That's right.
They're selling their energy for money that's worth the energy that they're getting in return. It's a bad energy trade.
That's right.
And then at least the one kind of panacea, or the one good thing that happens, is Volcker is a central banker, and he looks at this and he says, okay, we better raise interest rates fast because inflation started rising rapidly. Right?
If you read the Fed minutes, the actual meeting minutes from the late 1970s, Volcker assumes his chairmanship of the Fed over the summer in 1979. And he arrives at the Fed, and they have their typical meeting. Everyone's talking about the economy this, the economy that, leading indicators this, that, whatever. Volcker just takes the floor at one point and says, look, I'm terribly sorry about this, but this is not about the economy, it's about the psychology around the dollar. We're losing the confidence of the international financial markets. Something has to be done that's qualitatively different. What could that be? And a few months later, the US imposes, or Volcker does, under his leadership, a monetary targeting regime to try and limit the supply of dollars as a matter of policy, and that eventually, following double-digit interest rates, will restore confidence in the dollar.
And that finally basically peaks gold, because gold, since it's demonetized, it rapidly re-rates to 150, but then it rises to about $800 an ounce over the next kind of decade. And then when Volcker starts to raise the interest rates, that's when gold peaks, and it ultimately settles at around 300-400, where it sits for close to 20 years in oscillations, but basically interest rates are continue to be targeted by Volcker and then subsequently Greenspan, but still a relatively fair market interest rates. I mean, we're talking about interest rates were hovering between 12% on the high end to 5% on the low end. They never really got below 5, I believe.
No, I don't believe they did. But that level of interest rates was already enough to cause very serious distress in the U.S. banking system. The largest bank failure.
Savings and loans crisis, yeah.
Well, no, that comes a little bit later. This one is more mainstream banks. What happens in the early 80s is mainstream banks are in trouble for two reasons. There's domestic lending, which is distressed because of high interest rates, and the single biggest failure is Continental Bank of Illinois. No one knows the name today, but at the time, this is a big bank going down, and it had to be rescued by the Fed. But then there's all the international lending, the Latin American debt crisis. Citigroup, JP Morgan, Chase, all these big banks were hugely exposed to Latin America. And because all those Latin American countries were in either de facto or de jure sort of pegged to the dollar, that level of interest rates was crushing their economies as well. So the U.S. banks were on the hook for a lot of that and wanted the Fed to bail out Latin America, but of course the Fed wouldn't do that.
So since then, the central banks have been extinguishing fires. It's almost as though, had they not made that decision in '71 and just given away some of that gold that they owed their trading partners, they'd be on a much better path than they are today. Let's bring things back to the present, because it's only been about 50 years since '71 or '73 when gold was truly demonetized. The reason I think we're talking about this right now is, we're talking about CNBC and the CNBC interview we did today. I see a lot of the corollaries. Like this may be very similar. You've got the energy issue. Oil goes up to 140, now it gets destroyed, and it's extremely volatile. You've got currencies getting extremely volatile against each other, and the gold price is kind of sneaking up in US dollar terms. Deficits are record, budget and fiscal, and it's not inconceivable. Obviously, I feel like the event this time around won't be a country going off this gold standard, but a country going on the gold standard. So imagine you have a country all of a sudden, it could be the smallest country, that just says, okay, we can't deal with this inflation anymore, or deflation, and we need to go on the gold standard, and that sets off this chain reaction where to trade with that country you have to remit gold.
And that's where the exporters, the big net exporters in the world, are very interested, because these are the ones who are producing real goods of real economic value that the world wants. And they're receiving paper dollars and other fiat currencies in exchange, investing them in zero-yielding treasury bonds or zero-yielding Japanese bonds, whatever it is. That is not a sustainable situation. At some point, either one or multiple collectively of these big net exporters are going to say, wait a minute, we're giving away real goods for nominal goods, and the nominal goods have no yield or negative yield. That doesn't work for us anymore. And either separately or together, they will start to demand something real in exchange for real. And the logical something real, if you look at history, is gold.
I think the funniest thing about today's economy is how the naive economists and market participants think that somehow services are immortal. They don't have a half-life, a Microsoft operating system or a Google search engine. But the truth is that service industries and the output or the productivity of service industries has a half-life no different than commodities. You have to reinvest in CapEx, you have to reinvest in R&D. You can't use Windows XP anymore. You have to use Windows 10. To get from Windows XP to Windows 10 cost Microsoft tens of billions of dollars. So I think that it'll be very interesting, but I think it's very obvious that something's got to give, and we're very close to we've been playing this tug of war, but we're wearing down on the rope, and the rope is going to snap. And I think I guess the point of what I wanted to do in this conversation is, what were the signs in '67 that would have allowed you to say, because that was a major shock. If you were a citizen of the United States and you woke up and you could have bought gold at $35 before, and all of a sudden it just re-rated to $150. And then what probably happened to those people, unfortunately, is gold started rising, and then they probably started buying it at 300.
Yeah, they just chased it at that
300
point.
to 800, and then when it went back to 800, it worked. But actually, what they should have been measuring was what they could have bought in the 60s for.
But history, we look back into history, and we have this. I mean, most people have it. Even I have it, unless I open the book and read carefully. We all have this historical myopia. We look back at something like 1971 and think, oh, it was one event, it just pulled out of the blue, just happened. No, it didn't happen that way. There were actually significant financial crises, at least one a year, leading up to 1971. I mean, literally beginning in 1965, there was at least one small financial crisis a year. Nixon referred to those in his speech of August 1971. And he said, this decision will put an end to those crises. So in a way, it was the crisis to end the crises. It was the culmination of a series of them. And maybe that's kind of what we're seeing now. All the boom bust we're seeing now.
Happening on shorter cycles, shorter iterations, more, it's all of those big crises from, savings and loan, long-term capital management, tequila crisis,
dot-com bubble.
And now the iterations are just shrinking.
Indeed.
And at some point, it needs to be solved, not just kicked down the road, because the road's getting shorter.